Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll go through the market update first, and then we have our quarterly earnings release. So we'll talk about that, and Shawn's going to cover the past results, and we'll go through the plan for Q1 2022. So all right, let's get started. I've still got people entering. I got to click here. I think Jean has their hand low raised. I'm not sure. I don't know. Shawn, can you try and chat with Jean, see what she needs? Okay, so for market, pretty similar to what we saw last week. SPX 3, Russell 7, still had make big moves. I think we'll talk about where they are right now. Green Pie has crossed over into 60, quite a jump, pretty much doubled from that 30 level. Pretty crazy reaction from the market here. And we're about even on, ballpark state 1s and 8s. So let's look at the market pulse here. You see that the 14th or 15th was pretty much the bottom there, and it's just been a straight beeline down. So I would, I don't know too many people that would expect that move to happen. So myself included. How strong that move has been. We are getting up right near those like peaks here. I think we're right above the previous peak. So coming into resistance, we'll look at those on the charts. The new lows. New lows have pretty much, like trying to flatline. We're not getting any new high spikes. So I wouldn't call it, over yet. Like a flat line. I think we still need to, like a healthy thing is where, the lows are down here, and then you're getting like intermittent spikes from the grains, and the lows stay down there. But the lows are staying down. We haven't had a pop up since the 14th. So things are, have been rolling along pretty well here. If we look at the bullish bearish, we crossed over. We're at 60. We're as far as our like indicators, we're not near an overbought or an oversold. We're right in the middle of the range. Your oversold indicators at 30% on bullish, and then our overbought is 45 on state ones. So nowhere, we're just kind of in the middle here, trying to find our way. Had a big move up. Obviously, if you look at like SPX, we're actually only a couple hundred points from all-time highs, which is pretty crazy. Considering what's going on out there in the market. But let's look at the state. It's still in state 3, obviously, well above the targets. I would expect if we can hold above this like 46, I would expect it to transition to state 1. We'll have to wait and see on that. I think that's kind of a critical level for both things coming in right now, the Russell and SPX at these 2 levels. So we'll just have to wait and see. Not much information gleaned from there. Obviously above the 200, above the 50, we'll have to see if that 50 starts turning up. Normally we'll retest after we pop out of there. I think a couple weeks, last week or a couple weeks ago, I showed you, when we did, when they crossed above those, Usually we get a retest, not always, but usually, to see what is support and not. So I'd say, 46, we're only 200 points off the high for SPX, in that area. Pretty crazy. We never really dropped below that top bar for Fibonacci wise. So, we're still up in that upper band. I guess kind of wait and see if we can hold above these levels. I think that would be bullish, for both. If we can hold above 46 and if we can hold above 21, I think that's the critical thing to watch for Russell. It's been basically in that band since, 2 months, so a little over 2 months. So if we can hold above that, that's obviously very bullish for the market. If we can get up in that upper band right now, stay in it. I think we're currently right around, we're about 18 points above it. We're about 11 points above it here. So those are really the key things to watch. If we drop back down in here, I'd expect more, channeling movement. We've had false breakouts before with Russell. If we remember what we looked at, let me see if I can draw it. We had basically like a false breakout back here when we were tracking this channel for months and months. And then, November, we had that basically false breakout, and then it came back into the channel and then went down below into the next one. So I'd just be wary of that. If we can stay above 2100 Russell, I think, good things for the market. Otherwise, I'd expect us to get back in here and bounce around in that channel for a little while. So as far as the modeling, obviously, had a good move, got up above 2. Usually, we had a huge move yesterday. Not sure what really drove that. But, it happened. So we'll have to see if we can hold above that 2100. That's target 1 over here, 2100. Usually we get pretty strong resistance in this 1-2 area. We'll have to wait and see what happens here. But I think going forward, if we can hold above these levels, it's going to be good for the market, bullish, especially, earnings rolling in, going to pick up in a couple weeks here, which is, what we'll talk about in the second part of this. But if not, then I'd expect that channel. So that's the quick rundown on the market. I'll open up questions, comments.
Hey, Josh.
Mm-hmm.
Does it help me out? What is it saying that I think the 50-day is below the 200?
Yeah.
Or is that telling me anything that I should be aware of?
I mean, usually when it crosses, it can be like a warning sign. The key for that is, does the 50 turn into resistance where, it can't hold above there? We've had a lot of false signals with these. They call it like the death cross or whatever, where, I think we showed you, I went through a few examples either last week or 2 weeks ago. Sometimes it's the bottom, sometimes it's the start of a huge downtrend. So it's just kind of like a, warning sign,
Okay.
really. And if these turn into resistance, the 50 and 200 to the upside, where it's having real problems and failing, getting above those, then that's a big warning sign. That's typically you're starting like a bearish market.
Okay.
But it pretty much, blew through it. We had 50 resistance, after we turned down here, 1, 2, and then,
Yeah.
this last one, it blew through it. So, I don't, is this like a head fake? I don't know. It's hard to say. I mean, this market's pretty wonky right now, but I think if we can stay above these levels, 4,600 and especially 2,100 on Russell, then it's probably we'll be looking bullish for a while.
All right, thank you.
Mhm.
So Josh, this is Dave.
Okay.
I want to make one comment on earnings season because, like you said, it's about to kick off. But Micron reported like last night, and actually, I consider them they're like the last to report, but they're kind of like the early reports. I think for like the semiconductors that I look at a lot.
Yeah.
And they had a pretty good report, and I've been watching that particular. It's not a recommendation, by the way, to buy or trade or do anything with Micron. It's just one I look at as an upcoming kind of pre-signal.
Yeah.
And it was kind of like doing a double bottom, almost. So it's about like at the neckline of where that is. So I was pretty much wrong a couple of weeks ago, and I said we might be at a trading range, unless that was the bottom back at a couple of weeks ago.
Yeah.
And maybe this is the top, but it's right about that tipping point where you mentioned the SPX was. So this Friday's the jobs report. The market seems to have digested the rate hikes potential fairly decently, I guess, with this big move up.
Yeah.
But we'll have to see what the inflation factor is after this, and how that's interpreted with I think a 50-point move to the next
Like in May.
C meeting, which is in May, early May, not April.
Right.
So VIX is down to 20, down to 20. If you looked at that, it's moved pretty dramatically down to 20, which is still high. So
yeah, it's still a little elevated. I think.
Yeah, so I don't know.
I think we're all like really at key levels right now, and it's going to decide if we're going to go back in that range, or if we can cruise higher. I think in the next few days. And you brought up some good points. There's also, I don't know if you guys saw the Treasury bond rates. As of it was different yesterday. Obviously, the 5-year was higher than the 30-year at one point yesterday. I mean, they're pretty close, but you can see, they're talking about yield curve inverting, and it looks like it's starting to happen now. Is that like a skies falling thing? No, I mean, the last time it inverted was like 06. So, that was still like a, you had quite a run after that. But just something to, keep your eye on that. And the other thing I saw, there's a lot of talk about currency things going on with like Russia accepting, not accepting dollars or euros. And I think that starts on like Friday. So that could, cause some turbulence in the market. The petrodollar's been dominant since the 70s. So if other countries, stop using that as, the king, could cause a lot of turbulence, I think. But just one of the things I saw out there. So, thanks, Dave. Any other questions or comments? No? Okay, well, we'll move on to the earnings. I'll close all this stuff out. There's just so much. All right. So earnings, the share drive link that's in the email I send out every week or whatever. So I put in all our testing. And I'll go through one just to show you kind of any kind of changes that happen. But those are all in there. I usually put the PDF plan, but it's, they made changes to it, so it looks terrible. So we're gonna have them fix that, and then we can publish that. As far as, I think Shawn will talk about earnings plan. Everyone should have received an email with the earnings plan. If you didn't, then either chat me here or send me an email. It means you're not in the list, but everyone here should have got that. So what I'll talk about real quick, I'll do bullish pre-runners. So, I had 2,800 back tests for all these symbols. And, I'm not going to pull up the calendar, but I'm using the same characteristics as last time, 3%, 7 out of 10. We're doing the bull put, 1 strike below, and then the standard deviation. Obviously, if you guys want to trade something different, you can do your own testing. We just decided this one, seems to work pretty well. So, profit target 50% for all the testing. So we still recommend pulling out after 25 live trading, but we like to find the 50% for to find the best entry days. So we had quite a few, over 80. We broke it down into best trades. So that's a win percent over 90, profit factor over 80. And then any conflicts where they're appearing in both have been removed. I didn't see any this time. So we had some new fields that we have populated if you've done bulk tests recently. So we take in like average risk, the average, credit or debit amounts, and then, our profit. These were all the same from last time, but we added in these two. So basically what we're going to do this time, because we have a few trades that really skew the results. So you can see like CMG risk 12,000, Google 15,000. So anything over 2,500, we're just highlighting in yellow and we're not creating alerts for them, so that we can track basically a fairly level risk amount through all these trades. So if you want to do like NVIDIA or Thermo Fisher, I think that's what that one is, you'll have to do that manually, or you can create your own alert in the system. But, as far as our tracking, we'll try and do level risk, going forward. So that's the only changes. All of these other ones that aren't in yellow have been inputted, and you'll be getting alerts on those if they're confirmed or not. So, and, we can't do much about the pre-runners are, affected quite a bit, with these unconfirmed. But, like the runners shouldn't be as affected. So, but any questions on the changes there? Any comments?
I like that change. I generally don't take, something like you're showing there, Chipotle, that is such high risk compared to the others.
Right.
So, I think that'll make it an easier statistic to compare, because, that's how, at least that's how I really trade. I think how most people really trade is, you want to try and keep your risk per trade fairly level.
Right. Yeah. I mean, the CMG is like, 10 times the risk, the normal risk. So, that's just, the big change I think we're making this quarter is, just pulling those out, just because they'll skew the results, as you'll see with Shawn's results. one bad trade with one of these big boys, and your whole quarter's done. So
yeah, exactly. I've had that happen a year or so ago with Wayfair, and if they work, then your statistics look really great, but they're skewed that way. And if one doesn't work, then like you said, the whole quarter is gone, right?
Yeah.
So
you could be like 10-1, and this is your one loser and, you're break even.
Yeah, exactly. So I wasn't trading those big ones anyway, but I think it's good. I think that's a good change to highlight them for everybody. Not
Yeah.
some-
Yeah, I mean, if people still want to do trades with that, I mean, if you modify the trade characteristics, you could probably get the risk down if you want to still trade them. You do like one strike below for your buy. That'd probably drop it quite a bit, but yeah. So that's all. That's the big changes we made, and we apologize for the delay. This should have been out 2 weeks ago, so obviously some trades are going to be missed, but yeah, we had to iron out. We had a big data provider issue that our team fixed miraculously. So they did great work to get this up, and then we had to do the testing. So that was all I had, Shawn. Did anyone else have any questions or comments on the testing? No?
This is Dave. I have one comment, and it's kind of following right along with what Sadir was just saying. Because I've traded like TMO Fisher you have in there too as being a pretty high risk one. These are, our directional trades for the most part. So you can really adjust your risk just by adjusting the strikes sometimes too, to get them down into what's tolerable for you or, your particular trade.
Right.
And the only reason I mentioned that is because if there's some stocks that you watch and you're kind of fairly confident in, even though they're, just you can adjust the risk factor with the strikes as opposed to not doing the trade.
Yeah.
But I guess my question to you is would you even suggest that, or would you suggest staying with the actual trade and the idea behind the trade, not the direction of the trade? I mean, these are all based upon your reward too. So if you reduce the risk, you're reducing your reward too. That's kind of where I was going with that. Maybe that's not a good idea. Maybe that's not a recommendation that you guys think you might make. I stick with the strikes, stick with the actual trade versus trying to adjust. I don't know. What do you think about that?
No, well, see, our problem is we're trying to jam all these trades into one like cookie cutter strategy. So these high price ones just don't fit in that. So, I still think Google's a great trade. That's our gold standard, and kind of like pains me to pull it out just because it's so high risk. But, if you still want to trade that, then I still think these are still good trades. I would say what would be required, you'd have to drop the risk down. So you're going to have to go in and test these separately, maybe one strike apart on your bull put to see what kind of risk you have there, and just make sure that the testing still performs on that trade, and then you can create your own alert. So I mean, we can walk through how to do that.
No, that's okay. That's okay. I was, there's probably no right answer to the question. I was just wondering how, a personal feeling toward the, stick with the exact structure versus, ad libbing if you're, I mean, obviously we can do whatever we want, but I guess I'll just leave it at that. Everybody can do what they want.
Yeah, I would just say if you're going to change some, I would just test it just to double make sure,
Thanks.
Yeah, thanks, Dave. Okay. All right, Shawn, you ready?
Yep, I'm ready.
All right.
I'm ready. So I'll share my. What's that?
Nothing.
Oh, all right. So I'll share my screen. So yeah, I wanted to go. There's a couple things I want to show you guys. I want to show you one of the vol crush, this vol crush set that I did for this new quarter, which again is in this earnings plan here. Show you the summary for last quarter, and then go over some of those older quarters for you as well, and just show you some of the results as they come out. But I do want to kind of go back to what Dave was just talking about. So I think this, Josh, you can correct me if I'm wrong, but I think this is kind of, what you can do. I mean, you can try to do it a different way if you want, but Josh had that Google trade, which was 18 days prior, 18 days before earnings as a bullish pre-runner, and then using a certain strategy design. So you can always come into Delphian, you can go into your earnings, go into your calendar, make sure you're pulling your earnings between days correctly, the correct, stock list, and make sure you're using the screener correctly for the bullish pre-runners. And then you can actually do that trade testing yourself. So you can see when I did this one here, Google does come down a little bit lower. And you can see, the results that it shows here when the next earnings date is going to be. And then if you scroll a little bit further down, this is where you can make the adjustment to that trade strategy setup. So I did it real quick just to show you using the bull put strategy. It automatically changed it to 18 days, or 20, but let me change it to 18. And then, change, your profit target. You want to be profit target of a max, 50% of your max profit, which is what we're talking about, your stop loss, your days to expiration, keeping all that stuff similar to what Josh did. This is where you can make those strike adjustments if you want to do so. So you can change it. We have it set up as basically selling one, at the pretty much at the current market, and then using the put that you're buying as your lower standard deviation. So those different strikes can be adjusted. And when you do that, if I hit analysis here, I don't know what it's going to do because I had 20 days, now I'm having 18 days. So 18 days out, selling a put that's, selling your first put, which is 60 days at least to expiration, just above the lower standard deviation, and then using the put for protection that you're going to buy, which is 5 strikes from the put that you sold, 5 strikes lower than the put that you sold. You can see that if I do that analysis 18 days out, I'm winning. My win percentage is 100%, and basically I'm collecting a profit over those 10 trades of $3,800 and change. You can see down here a little bit lower my credit and then the profit that's received. So based on the fact that I'm going further away from the current market price of Google, you can almost assume too, with a 5 strike difference between the spread, that my risk is going to be substantially lower than the one that we were talking about earlier. But like Josh mentioned, if we do a bulk on a couple of these, we'll be able to see that, that debit and then that max risk as well if we do end up doing the bulk. But you can see just changing that strategy setup will kind of keep your risk. You can kind of adjust your risk based on that. Does that seem fair for everyone? Does everyone follow me on that? Does that make sense?
Yeah, that was good.
Okay. And I typically don't, a lower standard deviation is the one that automatically pulls up in my settings. So I was going to try to do one a little bit different, but that one shows the results like I wanted. So obviously if you wanted to do one, expected, or if you wanted to say, show me percentage from the current close below, let's just say below 1, you could always keep the strikes from leg 5, and then it's basically going to be selling a put spread that's right at the money that should have a 5 spread difference. And this one performs much better profit wise. We can see the profit on this one's substantial, but my credits are also pretty decent here too. So then we just have to see if we can look in that bulk analysis to say, hey, how much is my risk? What did my risk? Yeah.
We change that to 1, 5.
This one here?
Yeah.
Yeah.
That'll decrease your risk amount. Like 5 wide.
Oh yeah.
A lot of risk.
Still pretty wide. Yeah. So this one kind of goes back to that other one. So yeah, the 5 strikes from the leg. Yep. So yeah, just some cool things you can do to make those adjustments. Like Dave said, if there's one you want to trade that's a little expensive, definitely it's come in here and try to make some adjustments to it. This one just seems to work for Google. For another one, it could come up as a win percentage of 50%. And if it does, then then you say, hey, all right, well, that one might not be for me because the risk is too high and I can't find, a good strategy that's going to work better than the strategy that we've set up in that pre-alert. But that doesn't mean that, you can't find one if you kind of just play around with it a little bit. So not only the bull put spread, but obviously you can use other types of strategies too. Typically on, some other ones you can use just a different strategy if it matches up with your risk and the profits you're looking to get for the trade. So cool. Just wanted to show you guys that real quick so you can kind of use that as at your leisure. Like Josh said, there's not many that we had to exclude, but there are some. So let me go in there and show you guys in the vol crush. So I did the vol crush and I did the non-mover. So I want to show you the vol crush. Not much change for the vol crush from the previous quarter. you know, there are, I think a couple trades did drop off, but we can see here once this loads, all the criteria, like Josh mentioned on his, all the criteria here are the same. So I'm using, you know, 0 to 120 days is just to pull up the entire list, but I used our 4-legged option list because we are doing the iron butterfly. I used this screener here when I wanted to screen out the list, so you guys can follow along there. Here's the screener pulled out in detail. And then here's the trade setup that I used as well. The trade setup with the actual specifics, because some of those specifics are cut off. Go into with the raw data. We can see the raw data. Within that raw data, there's how many trades there were? About 148 symbols that had come about, but you can see here, there are some that have 50% win rate, 30% win rate. So I wanted to make sure and get all of those out of there. So I did just pull out all the trades that had a win percentage better than 90. So that dropped it down from 140 and change to about 6. And then I went a little bit further and I pulled out the ones that didn't have a profit factor over 8. So these are all of the vol crush trades that we have for this particular quarter that have a win percentage over 90 or 90 or higher, excuse me, and at least a profit factor above 8. So we can see these here, NXPI, J&J, DHI, and AMT. So these are vol crush, and I just want to reiterate something that I noticed in the testing whenever I was running some of that analysis and using the virtual portfolio is originally, you know, when we set up these vol crush trades a year, 2 or 3 years ago, however long ago it was, you know, the vol crush is really just taking into account that volatility crush of the earnings announcement happening, and then, you know, then basically getting out of the trade. So all of these vol crush trades, I made sure to exit the very next day. So if I get out, you know, let's say the earnings announcement is tonight and I'm doing the vol crush trade prior to the close tonight, I'm executing the trade this afternoon, and then I'm getting out of the trade tomorrow by the close no matter what. The only exception there, I guess, that I would say is if your stock does make a big move outside of the expected range and your risk at that point is pretty minimal, that's where you would want to consider possibly holding on to the trade, you know, because you're pretty much at a max loss and you still have, you know, approximately, you know, 5 to 10 days left on the trade. So really not a reason to get out at that point in my mind if your risk is almost negligible, but your potential for profit, or at least your potential for break even, is substantial at that point. If it does move outside of those legs, and you can see that on the risk profile of your trade, you know, how much the max risk of your trade is versus where your trade is currently at that day. And you can make that decision for yourself as well. Again, there's only 4 of these, so you know, not a big set. And I think of the non-movers, you know, there's maybe 7 or 8 of those, so not many of those either, maybe 6, I think. So I set them up that way. You guys can kind of play around with it. And again, similar to what Josh talked about on the other ones, you know, if there's trades in here, or what Dave talked about too, if there are symbols in here and trades that you do like to trade, you know, you can obviously pull those symbols up and see how they perform. You know, like let's just look at Google real quick. If we pull up Google, or Tesla's right below it, you know, we can see that those two have performed, you know, 60% win rate. So not that great. I think H is the profit factor. So column H here is profit factor. So we can see that profit factor of Google for this trade is below $1, but you can see the Tesla is actually 5.5. So, you know, if you like Tesla and you think that they're going to be fairly mediocre, that might be one that you want to trade, even though it's a 60% win rate. But again, that's just something you would have to kind of digest your own and make your own decision to do so. But, you know, you have all this data here to check out and kind of run through it. So any comments or questions on that?
Yeah, Shawn, this is Russ. Why are you
Hey,
using,
Russ.
I mean, if we're getting out the day of earnings, why do you have a month out expiration? Why not just use the weeklies?
Yeah, well, these are using the weekly. So these, you should be using the weeklies, and you should have at least 6 days to expiration on them. And the reason I use 6 days to expire is because if it's a Wednesday, I don't want to get out this week. If I'm getting into the trade on Wednesday, I want to use the options that are expiring next week.
But when you
So,
look
yeah,
at the
when you're
expiration, yeah,
making,
when you look at the expiration date, they're all in May when the earnings is in April.
yeah, these when you're pulling those backtest report, it's just showing you the next expiration as a monthly option. That's just some of the coding that the IT guys have in there. Some of the times I took these out because these aren't really relative to the trades here. So always look at your criteria when you're setting it up. So sorry for the confusion on there. I might make an adjustment and add that back in there. But whenever the analysis is ran for the back test, this is all back test analysis that they do. So when it runs, it's just running it and it's pulling in the next expiration. That's just a field that they have that auto populates there. But yeah, for the vol crush and the non-movers, you definitely want to use options. You want to use your weekly options, and you want to use at least 6 days to expiration, and that should always pull in that next week's option expiration for you.
Okay.
Yeah, sorry for that confusion, Russ. I apologize. Yeah,
Sure.
I'll probably change that because I've seen that on some other places, and I was like, oh, okay, I don't really like it. Even on your earnings calendar, it shows you the next option expiration as a monthly, which I think that can be kind of confusing too, even though the stocks do have weeklies. But for all the vol crush and non-movers, that's one of the changes we made a couple quarters back was we made sure that all of the vol crush and non-movers have weekly options available. If they didn't have weekly options, then we typically, they should not be part of this trade set. Any other questions or comments, anyone?
The maximum risk, is that like you have like $259? Is that your maximum loss that you will?
Yeah, so like that takes the average. So it's going to take the average of the 10 trades. So for that NXPI, it's going to take the average for the most recent 10 trades, 10 quarters, and it's just going to average that out. So on average, you're going to get a credit of about 770, and then on average, your max risk will be the 259 and change.
Okay.
So those are really great trades, and I would hope that we can see a lot like that because like we've talked about before, those are some really good, like those are better than 2 to 1 if you're looking at risk versus reward on those. So, and I think with pulling some of these trades, pulling those all of the 80s and below out, and then using this higher profit factor, I hope that's going to get this set a little more narrow for us and be some of these better trades, if you will. And obviously when the trade alerts come out, that's definitely one thing that I look at. If I'm not getting a good, risk versus reward ratio on the trade, then I want to look at that trade a little bit more in detail and say, all right, well, do I really want to do this or not? If you're basically risking, if you're collecting 500 but you're risking 500, that's kind of one of those trades I'm like, it should be a little bit better than that based on this fall crush or this non-mover trade. So that's exactly what those two columns should be there.
Shawn, this is Dave. I have just a real quick question on the screening part. Do you check for to see if the stock is going to split or not? I only may bring that up because I think this quarter there's one or two high-profile names that are splitting, and I don't know whether that would be before or after. It might not even affect the trade as long as you're out before the split happens, but if you put in an expiration that's after the split, that might have some adverse reaction. I don't know.
Right. Yeah, and that's definitely something that we all want to make sure we're paying attention to, right? Because I think you have Google, you have Amazon, and then even Tesla now is talking about trying to split as well. So yeah, those are a couple things that you want to make sure that you have in mind, and this screener does not. So this screener does not take that into account. So that would be something to write down. We only have this as the part of the screener based on what it's done in the previous quarters. So it's not looking into that split that should be upcoming. I think they're all happening in June. Don't quote me on this. I wanted to say June, but I could be wrong. And
I didn't know either.
Should be.
Yeah. Yes.
Yeah, I think June, but most of all these are April and May, and the other ones are as well. But I don't think any of these are going to be splitting either. So. Definitely be aware of that because those are some pretty decent things to make note of, and especially now a lot of these companies are splitting or trying to split because their valuations are so high. I guess is the reason. I don't know the exact reason, but it's something to pay attention to. All right, cool. Well, I wanted to show you guys that. So yeah, those are always here for you guys to check out within that share drive. There's really some great stuff in here. So please pull it up. And again, all of those are in PDF, all of those are in Excel format. So again, you can make, adjustments. You can use those to help track some of your trades. I do that when I'm tracking the virtual portfolio, which is what I'll show you now as well, or in a second. So I just use my own color scheme and different things like that to try to help myself get a bit organized. But you can always use those sheets to make those manipulations, if you will. But again, if you make manipulations to the actual numbers, that's where you're kind of on your own at that particular point if you're changing a lot of the numbers and stuff. Let me go in and I will show you this summary. So just to preface this summary piece, like Josh mentioned a second ago, we had some decent issues last quarter with the service provider and providing the earnings data to us. So a lot of the trades that were coming out, even if they were runners, they were coming out as an estimated date. So I had to be really careful on the way I wanted to present this particular piece. And the only way that I could do it without, showing any subjectivity in it was basically just to do only the trades that came over as the pre-alerts as confirmed trades. So if they were on the pre-alert as confirmed, and I tracked them within this virtual portfolio results. I did track all of the other trades, the estimated trades as well, but I didn't put them in this virtual plan results here. So going from column B, going from the left all the way over to the right, we can see. Let me see if I can minimize it a little bit, and you guys can still see it. Column B, we can see the bullish pre-runners. We actually had a total net loss of $8,100 for the quarter. Profit factor of 0.12. Only 8 trades were confirmed for the bullish pre-runners, and we've talked about that where we had so many different trades, but only 8 were confirmed as far as the pre-alerts were considered. Out of the 8, 6 were winners, 2 were losers, 75% win rate. So good win rate for the most part, above 70 I consider is pretty good, but in this particular factor you can see we lost money. 10.6 were the average day that we were in the trade. And here's the big one that we talked about before. My minimum risk on some of these trades, the smallest risk I had was 1252, but the biggest risk I had was 14,520. And then the average risk was 3,700. So substantially higher than I think what a lot of us want to put on as risk in our particular portfolios. We can see that out of that set, 39 of those total, 39 of the trades were estimated. And then we had 29 trades that we did not trade. Now 39 were estimated, but 29, we had a section there, I think, the end of December coming to January where, our server was down. So a lot of the trades that were coming out did not trade were during that time of the server being down. So we didn't get any alerts coming out at that particular time within the platform. So that's why we see that did not trade of 29. One thing that I wanted to bring up, and Josh mentioned,
Shawn?
Oh yeah, perfect. That's what I wanted to show you guys. So let me go into these results here. Let me see, confirmed. And there's 2 big trades, right? So we can see that here's the download. So I downloaded this from the virtual portfolio. So here's the bullish pre-runners confirmed. And if you look at this list, only 8 trades again. But if you look at this list, you can see max risk on CMG, 13,000. So we lost $6,000 on that trade. And then Netflix 6,000, and we lost $3,000 on that trade. So barring those 2 trades being in the portfolio, this would be 0, and our net profit on the trades, if we kept that risk to a reasonable standard, would be $1,100, and we'd actually be at 100% win rate. So I know I can't go back in time and just cherry pick kind of the different things that I want to do to make the portfolios look better. But that's pretty huge. If we keep that risk pretty manageable, that will make this set column B, look a whole lot different. So
that's still pretty impressive. If I look at it from the way that I actually trade, which, as I mentioned, I would have not taken anything that that exceeded my max risk per trade. So,
right.
I got real bearish in January after I came back from vacation, and I avoided the earnings plan. But now looking back, if I had actually done it, even with a downward market that we had in January, February, March, I wouldn't have taken those 2 trades anyway, because they exceeded my max risk per trade, and it would have ended up winning all of the ones that were confirmed. So that is very interesting. So, I think the fact that you guys are changing that in your virtual portfolio and in your recommendation is good, because you know, that I would have had 100% win rate, and I didn't take any of those trades.
Right. Yeah, that's fair. You're having the tone, and I think, like you said, that Joe, Josh, and I talked about that this morning, and it just really shows almost the strength of some of these trades, even with this market that we have right now, to be able to come out and have the results that we have here seemed pretty good. It was surprising, you know, but they seemed to work out, so it was good. I did have, so this is within, so I did have the virtual portfolio, so I do have the ones that are estimated, and we can see with some of these estimated here, you know, there was a lot of trades that were estimated, but, you know, I haven't pulled out all of the numbers yet, but you can see some of these big losers, you know, there's another Google one, but we can see 3,900 for the CLAC, you know, was a loss of 2,000. This LRCX, a loss of 4,000. So a lot of these bigger trades we can see now would have taken that down substantially, but we didn't trade these because these were the estimated. But where it did make a pretty decent difference was on this H column here. So not only does it help out in column B, help me get to a profit, in column H, it actually reduces my profit in column H, but it doesn't reduce it to an actual loss. It still lets me have a profit on my bullish runners of, I think, like 45 or 55 bucks. So it was interesting that, you know, it did shift both of them, but it still shifted it, you know, it didn't shift it to the negative category. So my bullish runners, which is what I have here, confirmed bullish runners, we can see that a lot of these trades are, I think there was 25 maybe of these trades for the bullish runners. So 25 total, but we can see some of these trades when we're looking at our max risk, you know, so we have this trade here. Lily was a $2,700 risk, so we would take that one out, which would be a profit. We would take, you know, that one would be okay. Let's see, there's some other ones here. This one was another, URI was a winner, but again, we would take it out because it was a, you know, it was above the 2,500. And then we get down to some of these other ones here. This is a loser, which would drop me, you know, with 92 bucks for Microsoft, but 5,000 here. So this is one as well that was a profitable trade, but would have met the criteria because of the risk. So anyway, so just kind of going through it that way, you can see that I took out a bunch, it would have taken out a bunch of winners for that set, but it wouldn't have taken out enough to bring me down to a negative number. It would have actually brought me, like I said, down to a positive 55 bucks or so. So my win percentage would have changed a little bit. You know, I don't know which way. I didn't really run the analysis on the estimated, but I just wanted to show you the good with the bad, right? For column B, taking those out would have helped me turn this one into a decent profitable set, but it would also have dropped the profitability on the bullish runners trade as well. So, you know, you could take the good with the bad on that.
Yeah, but if you remove the 9K from column B, I think even with the drop in column H, you end up at a profitable quarter, which is, you know, which is really something considering what the S&P did this quarter.
Right, you're exactly right. You know, so it would have been really, really good. But you know, like I said, I think taking those ones out is where we're going to make that adjustment. That's going to be the key, I think, for this particular, you know, quarter coming up. So there's the numbers. You know, about 4,200 bucks profitable, plus about 50, I think, if we took out those risky trades or those higher risk trades, we would still walked away with a, you know, profit of about 4,200 bucks, which, yeah, I mean, I think is pretty awesome. So, other than that, I mean, that's pretty much what I wanted to show you guys on these particular trades. You know, you can see the vol rise, only one trade qualified, and basically we had to get out because of the earnings announcement was coming up, but that was a $55 winner for the long strangle. Volatility crush, 3 trades qualified, and all 3 were winners on the vol crush trades. Price non-movers, we can see we made a profit on that. 6 total trades, 4 were winners, 2 were losers. And then again, our bullish runners was our pretty decent category, 25 total and 17 winners for a 68% win rate. The main thing with the bullish runners is, again, I had to be, I couldn't really just say, well, let me assume that's a bullish runner. We know the earnings date happened yesterday, so we're going to get into the trade. I still wanted to keep it kind of a level playing field with our pre-alerts. So if the pre-alert said it was estimated, then maybe that trade date had changed. You know, I didn't want to verify it, so I only wanted to trade those that were confirmed. So that's one that can be a little bit, you know, in that gray area, because obviously if it's a bullish runner or a bearish runner, typically you know that the earnings announcement has happened the day before because you're getting into that trade now. But some of these did still show up based on that data as estimated, so I didn't want to use those trades. So that's it. Does anybody have any? And this will be, I'll put this in the in that shared file folder as well, so you guys can pull this up and see it. But any questions or comments on this file?
Will you have the detail file out there as well?
I can put those in there too. Yeah, for sure. So I have all those. So I have all those files here. Let me see. So I have all these here. I even have the confirmed and estimated ones. There's one in there. So I have a bullish pre-runner bullish. I don't have a let me see. I don't have a bearish pre-runner confirmed here because again, there were no confirmed bearish pre-runners that made it onto that list. So that's the only reason I don't have those particular files. I might create a file and just say no trades, so then we know we're not missing any type of file. I can put all those on there as well.
Okay.
And then what I wanted to show you guys too is what I do as well is I go into these and I save the pre-alerts every day. So I have a file where I save the pre-alerts every day. But then I wanted to show you guys on some of these trades. This is the bullish pre-runner list that I have. So this is kind of how I manipulate it. Again, you know, from to help everybody on this call, column A, you know, I use the holidays to make sure we're tracking them. But if you look at this, this is the file that I download and how I track it within, you know, the virtual portfolio. So we can see a lot of the yellows here. I have a little sidebar note over here. A lot of the yellows are when the server was down. So you can see December 29th, 27th, 29th. Some of these are a little bit later. Cake, the entry date would have been 128. So why that one didn't populate, that I have to look at that further with the IT group. But we can see that the yellows and the oranges are ones that were either yellow, orange, and red are ones we didn't trade for whatever reason. Server down, the trades were estimated, or the trade just never populated. But the ones in the green are the ones that we actually traded, you know, within the virtual portfolio that were confirmed when they had come out. So if you look at this list, you can see a huge discrepancy in how many that we have in green that we actually traded versus the other ones that were not traded. And that's where we're obviously getting, you know, that 8 number versus the, you know, I think 70 something that we should have had. So big difference there. And we're hoping the new data that we're getting now is going to help alleviate that. But, you know, again, if these dates aren't confirmed and the, you know, the companies aren't required to do so, there's really not much we can do at that point where our hands are kind of tied to what we can do. So again, as always, I feel just make sure you're using, you know, ours, Delphian as a source to look at the earnings date, you know, but also go to that investor relations website or go to TOS or whatever other system you use to try to make sure you're confirming that date as well, just to make sure you get at least 2 confirmations of when that date is going to be for the earnings release. But yeah, this is kind of how I do that. So I know it's confusing with all the different colors, but I can't figure out a better way to do it myself. So I'm trying to work through it. So.
Shawn, Dan here. I got a question for you.
Get in. Yeah.
Is there, in your experience, is there any of these trades, whether it's a vol crush or any of these trades that would be more insulated to the overall market conditions? Like, you know, I'm looking like the vol crush, and I'm thinking there's a lot of trading overnight, a lot of volatility in the market, and you get these big gap ups and big gap downs. And, you know, I can't help but think that wouldn't impact our trades, you know, and I'm just trying to figure out if we should be factoring in the risk that we have in the overall market. You know, how far are we from a top? How far are we from a bottom? You know, the volatility, implied volatility, and all that stuff. You think I'm being overly concerned, or is there a way to, you know, factor that in as well?
No, I don't think you're being overly concerned, you know, because again, all these trades that we're doing for, you know, our earnings plan or even our studies, really, you know, those are just taking historical event, what has happened in the past, and and excluding a lot of that other noise that has happened. But I don't think you can disregard, the Fed raising interest rates or the war, in Ukraine with Russia. So I think there's a lot of other external factors that you do need to take into account, because those are affecting the market, and those are affecting the psychology of the market and what's going on. But I think a lot of these trades, a lot of these earnings trades, and a lot of the trades that we have for the studies, they happen pretty quickly. So you're in and out of these trades fairly quickly. So I think that's where we're able to capture some of these results, these positive results, is because you get in the trade today and you might be out in a couple of days. So you're able to catch that little bounce. But no, I think having that reservation is good. I mean, that's what kind of helps you stay in check with your own portfolio and with your own money, right? But I would say disregarding all of these trades just because you're concerned about what's going on in the market, I don't think that's going to be prudent. But you have to obviously do what's right for yourself and what's going to make you sleep well at night. But yeah, I think the vol crush, for me, the vol crush and the non-movers trade, I mean, I really like those trades. Like you said, you're in and out pretty quickly, and I think that you're kind of taking all of those external factors out for that overnight trade, and you're just really basing it on what's happening with the earnings announcement. Now, obviously, what's happening with earnings goes into effect of what's happening around the world, because that could affect that company's longer term view. But I think consistently, I just like those trades. But like Sudhir mentioned, even though we're still somewhat bearish on the market, you can see that these trades still work pretty well for the most part. So still trading them, I think, is still going to make you money, but I can't guarantee that, right? So it's tough, but I do that. If I see a trade in here that comes out for a bullish pre-runner, and like Dave mentioned, if it's NVIDIA and I'm just not too certain on NVIDIA, I just might not trade that trade just because of my personal bias, right? I might kick myself in the butt because the trade would have made money. But if I have some type of personal bias, I might just kind of be a little more cautious and not do it. I don't know if that answered your question or not.
Yeah, no, you have. I appreciate it. Thank you.
But but there are other things. We've talked about it before. We couldn't add any of those moving averages or anything like that to the charts when we're running the back test. But if like today, I think we had those pre-alerts. Since the pre-alert was put in this morning, we did have some trades that came out today for the pre-alert morning session. So, these came out today for the trade date being today. I think 2 were estimated. So these 2 are estimated for the bullish pre-runners, but American Express is confirmed. So if you look at American Express and it's above, the price is above the 50-day moving average, and that's what you're going to use as your confirmation, then great, then trade that trade. But if it's, if it's below the 50 and you say, hey, anything below the 50, I'm not going to trade it, and it's below the 50, then don't trade it. I think those are where those trade rules and those plans, I think, come into a big factor. Is if you can set up a reasoning beforehand of why you would do something or why you would not do something, and then stick to that for the quarter, I think you can never go back and be like, well, maybe I should, maybe I shouldn't. You have the plan and you can stick to it. I think that's a big part, but we're just not able to do that on a lot of these trades when we're putting out that plan. So, and somebody had mentioned that before, using those moving averages. So I don't think it's a bad idea.
Yeah, I'm looking at like the moving averages, trying to incorporate those in the plan before I place a trade, and also like even like on a what do you call it, a bullish runner. What's the one I'm looking at? The bullish, the pre-runner. If the market is acting up and getting really kind of crazy with volatility, I'm thinking that, there's not a lot of people that are going to, they're going to be holding off on the trade. So I'm thinking like, the volume could be low, and then,
Right.
you may not get that, a lot of price action because of low vol, so,
Right.
and that's what I start going down that rabbit hole, and I end up making, a lot more work for myself trying to make a decision, and I end up with analysis paralysis. It's like
Right. Sure. Yeah, always just kind of have that written down. If you want to make sure, you always want to make sure that the earnings dates are what they're supposed to be. And if volume, is going to be one of your key factors, just make sure you have it written down. Like volume has to be above, 500 for this particular strike or something like that. And if it doesn't meet that criteria, then just push it to the side. It's easy. Hey, it didn't meet it, so let me move on, right?
Yeah.
And then implied volatility. I think one thing's pretty good about the trades, how we have these set up as bull put spreads, right? I think, and somebody can correct me if I'm wrong, but when you're doing a bull put spread, right, you're selling the spread. So when you're selling options, you want the volatility to be high. So I feel that when you're selling these put spreads with implied volatility being high, I feel like you're going to get a little bit more of a credit for these trades than you would if volatility was low. So the volatility in this instance might help you out, a little bit, right? But yeah, if you're just completely, at a loss of where the market's going and you're just not comfortable trading American Express, by all means, don't trade it. These are just ones that we've tested and they've just performed well. And again, it doesn't mean they're not going to perform well this quarter. They could perform good or bad. But, I've talked about it before. I definitely don't want you to do a trade that we've back tested just because we back tested it, right? That's going to be the worst, because if it doesn't work, then that just puts that bad taste in your mouth. And you're like, oh man, now you're really second guessing yourself and what we're doing. So, have a plan. And if it doesn't match them, just don't do it, because you can never get mad at yourself for following the plan that you initially set up. So.
Yeah. All right.
Or you
Thank
can, but you shouldn't. Yeah, no worries.
This is Dave. Could I comment back
Any
on
other
Dan's?
questions? Of course.
This is Dave. I wanted to comment back toward what Dan was bringing up about, should the volatility of the market affect my current trading strategy? Well, 2 points. Well, the implied volatility is built in already to the premiums in these trades. So the market makers are sort of already taking into all the facts that we know. Now, if you have an idea about a risk factor that's not built in, that's when I would be concerned. For example, if you thought the war was going to escalate, the war in Ukraine is going to escalate next week, then I might hold off. But that's your opinion. If you don't have any other, if you can't think of a reason why one of the major risks is going to change, then I'd kind of stay with the trading themes myself, because I think they're kind of built in. And as Shawn just pointed out, these are pretty short-term trades. So unless you're really concerned about some event that's going to overtake the time frame of the trade that's on the table, why bother? That's my opinion anyway. That's just an opinion, but I don't know whether I'd be too overly concerned unless you thought, hey, the war's going to escalate, the war's going to end, we're going to have a really, really high, CPI reading, or the employment's going to go to pot, then those are big changes. But if you don't think anything, if you can't think of anything that's going to change in the next time period that the trades are, on the table for, I wouldn't worry so much. And that's just my opinion, but that's where I would evaluate the risk of a new thing versus something old. We know what we know, but we don't know anything new as far as risk go.
I agree with Dave. I felt that I stayed just completely out of the earnings trades because I felt that with the Fed tightening and inflation and all that, we would have a down quarter, which we did. And therefore, my thought was the earnings trades, which are generally bullish, wouldn't work. And so I just stayed out of them completely. I found trying to add analysis to the trades, maybe moving average crossovers or things like that, because they are such short-term trades. It usually just, creates paralysis through over-analysis. Either stay out of it or just take them as they are, right? And now looking back, I wish I had taken them because I would have avoided those high-risk trades anyway, and it would have been a successful quarter. So, I agree with Dave. I think, you either just take them as they are or stay out.
I appreciate that feedback, because I'm looking forward on these trades. Is there's like a field full of mines. Every time Powell speaks, the market reacts, but I guess, that's something you can't avoid. But as you said, Severe, you're a prime example of kind of a reinforcement that I need, because you're saying that even though you have a bearish outlook, looking back, those trades would have probably worked out pretty good for you, so, that's good news. And
Yeah, and I'm amazed at how many quarters that worked for me, during various market conditions. I think you guys, Shawn, correct me if I'm wrong, I think you started introducing these in 2020 or 2020. So,
Probably 20, yeah.
yeah, and this is the first quarter where I just got spooked by inflation and decided to stay out. It generally worked for me as long as I follow my rules. And I generally don't add much. I don't add anything to them other than that is not in the plan. Other than I was on top of the plan, I had my max risk per trade parameter that I was using, and now it's in the plan, right?
yeah, one of the things I think about is, if you look at historically when we had rising interest rates, surprisingly, the markets did pretty well. And so there's the old adage that the market climbs a wall of worry, and we certainly got a lot of things to worry about now. But where else are you going to put your money? I mean, I think people are actually being forced into the market, because if they leave it in the bank, your money's going to be eroded just through inflation. So I think that's an impetus right there to invest in the marketplace. And and I think that's why I think a lot of people are surprised how far the market's come up in this, the last couple of weeks. Will it be volatile? Yeah, I think so. But I think, I think there's an impetus for the market to continue to rise, even with all the worry. So.
Right.
That's just my opinion.
Yeah. Yeah, right. Yeah, and it's fair, right? I mean, we all have different opinions. Like I said last week too, I think some of the analysis that Josh does is great. So it kind of helps you navigate. And like we've talked about, you don't want to use all of your portfolio to put into these earnings trades or the studies trades, because we are trading options that are, fairly speculative, right? But having that back test and using it, and I think sometimes using your gut feeling, but I think it's not. I think it gets to be a problem when you're using it one day, but then you see an Apple trade and you're like, oh, well, maybe I won't do this maybe I will do this trade on Apple. I just didn't want to do it on Amex or something like that. I think that's where you get a little wishy-washy and you might cause yourself some problems. So, just have the plan and stick to it. I think that's going to be your best result. If you have something that you feel like is going to be crucial to your trading, then, write it down and just follow it. So. Well, good. Well, thanks, guys. I know we're over a couple minutes, but, I just wanted to show you guys that. I'll put all that stuff in that shared drive. I mean, that's all I had. And, if you have any questions or anything that looks a little strange within our pre-alerts or within our earnings stuff that we have, definitely let us know. Again, we're getting that new data, so everything should be pretty much flowing as we expect, from here on out. But if something does look a little askew, definitely shoot us an email or give us a call, and we'll see if we can get it corrected if it is something that needs to be corrected. So,
Hey, Shawn, I got
that's all
one
I had,
question.
Josh. I appreciate it.
Josh,
Yeah.
I have not been getting anything from Delphian high probability studies. It keeps on saying no symbols matched. I wasn't sure if.
Yeah, I noticed that also. I've been obviously focused on other stuff, but what we did, we took out the anything, because there's like two tabs. One was just for the studies, basically low probability. So we got rid of all those since they were confusing. So now it's only going to populate the high probability, not the raw output. So I think that may have triggered something. So they're looking into it. We'll have that resolved within a few days, I think. Sorry. But yeah, I noticed it too. So they're looking into it. We'll get it fixed there.
Okay, I just wasn't sure if it's something on my end on
Yeah, no.
settings or something.
No. And, you know, when there's big up days, like consecutively, you're not gonna see many, because a lot of these are looking for pullbacks, so. Cool,
Okay,
yep. Thanks, Russ.
you
Yeah,
bet.
studies have come back. They were down pretty hard, and like it did, yeah, this up thing really got them back breathing. So cool. Well, thanks, Shawn. Thank you, everyone, for tuning in. We'll do it again same time next week, and thank you, and we'll talk to you then.
Thank you, guys.
Good meeting.
Have a good week, guys.